of becoming a homeowner. So I am super excited for you guys. And the Spark program is something that I created at the end of the pandemic. Well, I don't want to say the end of the pandemic because we're still in it, but at the end of 2020 for some folks that I noticed were having some challenges getting their finances in order to become a homeowner, because it's a different thing than just creating just a budget. It's a layered approach. And so I wanted to create something that they could have that was tangible and that they could follow up a path to get to where they wanted to regarding home ownership. And so just to tell you a little bit about myself, I am Elijah Ingram's mom. So Elijah actually comes to Create Me and hangs out with some of your kiddos. Also Brandon Jones' fiance. So I'll be getting married in June. So I'm super excited about that. But regarding real estate, I am a 7-year veteran in the game. I am a capper, and a capper is not the cap that your kids are talking about, cap. Is that once you sell a certain amount of real estate, you get to keep your money for a cycle or for a period of time, and you don't have to pay commission to your firm. So you just have to sell a certain number to hit that number. And it's a blessing to be able to be a capper because you get to keep a little more in your pocket day to day. I'm also a certified seller representative specialist. So I took a course that has ensured that I can assist people that want to sell their homes and make sure that they're efficient with that. I'm a co-chair at the Greensboro Regional Realtors Association, Realtors Community Service Committee, as well as the director of onboarding and training for my team, which is Carolina Expansion Partners. I am a lead agent and a coach, and I have 4 agents that I coach every month and help them to hit their goals as being agents. In addition to that, I have about 15 years of training experience, as well as 4 years of curriculum design. So now that we have that out the way, let's jump into it. And guys, I do want you guys to feel free to come off mute and ask questions as we're going through this. Everything is a little bit better when it's a conversation. I can't personally stand a lecture. So if you have questions or if you want to laugh at some of my corny real estate agent jokes, feel free. I appreciate the interaction. So on my agenda today, we're going to talk about the basics of the real estate market, as well as the benefits that you would have in being a homeowner, because a lot of times people think of it as just one thing. I've got home or I've got property that I can pass down to my child or to my family members, but it's really a lot more than that. We're also going to talk about the purpose of the S.P.A.R.K program itself, as well as making sure you have some resources that you can use to follow up on after this training. So before I get started, do we have any questions, concerns, hostilities, or frustrations that we need to get out besides gas prices? Anything? All right. Now I'm going to get into it. All right, so the biggest question that I get is, Lynette, what kind of market is it? Right now, it is a seller's market. Does anybody have any idea what that means? I'd love for you to come off mute and tell me what you think a seller's market means.
I think sellers have the advantage.
Say that one more time, Amina's mom.
Sellers have the advantage currently in the market.
Spot on. Bingo. Sellers have the advantage. Does anybody know why?
Because right now values of homes are high, so it's a good time to sell your home if you're looking to get out of it.
Yeah, absolutely. And the reason that home values are so high, guys, is because everybody is wanting to buy a house because interest rates are low. So some of us, I'll raise my hand, are old enough to remember that there was a time where interest rates were 18%, 10%. Some of us remember 5 and 6%, but never have we seen 1.5%, 2%, 3% interest rates. Now, if you know anything about finances, you know that when you have a lower interest rate, you're paying less money over time for whatever that loan is that you have. So if you have a credit card with a low interest rate, whatever you're borrowing, you're going to pay less money on that particular balance over time because you have a low interest rate. You're going to pay more to the principal balance or what you spent. Well, the home loan is very similar. Whatever your loan is, If you have a $200,000 loan at a 1.5% interest rate, you're paying more down on the $200,000 than you are on that 1.5% interest over a 30-year period. Okay, now obviously there are different types of loans. There's certain things that we could get into, like FHA loans and PMI and all these extra pieces that they add to your loan over time. But overall, on a basic foundational conventional loan, if you have a low interest rate, then you're going to pay less money over time for the same house. So you increase your affordability. And so when your affordability is higher, you get more house technically for a little less money because you're not paying that interest rate over time. So when you think about everybody looking at this thing and they're saying, oh my gosh, I could get a house. I can finally afford a house because the interest rates are low. And so it just pushed a whole lot of buyers out into the market in the middle of a pandemic. And sellers were like, oh, they want my house. So some people really got scared to list their houses. And as a result, inventory was low, and demand was sky high. And so as of right now, there are about 1,050 and maybe 1,400 today on the market. And there are about 5,000 to 6,000 buyers in the triad that are looking to buy. So when it's a seller's market, it's because that demand is so high that they can really pick and choose what they want. So as a listing agent, just the last listing I had, before I even put it on the market, it was in a coming soon status so people could kind of preview it. We had 4 offers on that house sight unseen, and one was for $25,000 over the asking price. There were very few people that could compete with that. No repairs, no inspections, no contingencies, closed within 5 weeks. Actually, it was 4 weeks, closed within 4 weeks. And so that's become really, really difficult for folks that are traditional consumers that want to have, I want to come out here with my loan and my money and I want to buy a house. But they're not able to compete with a lot of these investors. And so I want to make sure you're educated as far as what type of buyers can win in this market. Now, as listing agents, we do have the ability to talk to our sellers and say, hey, an investor's deal is not always the best deal. Some investors are going to just take the home and put it up for rent. What are your thoughts on that regarding how the impact could be to your community? And so some sellers are saying, no, I won't sell to investors that are going to do that. And I'm going to just deal with people that are traditional consumers. And so that gives buyers a shot at actually buying a house. And so the strongest of the strong are the buyers that can win in this market. So who is the strongest of the strong? Any idea who the best buyers are in this market? Anybody? Hi, Jennifer.
I say corporations and businesses.
Okay, corporations and businesses, they're winning, that's for sure. And a lot of your sellers are taking advantage of those. But for those sellers that say no to investors and businesses, who do you think the next best buyer could be?
People with
First time.
Okay, I think I heard the answer. With people with who?
family, because then they can look at the next generation and still it's going to be a long-standing relationship.
Okay. Okay, I like that thought process. And I wish we could consider people based on the fact that they have families as a buyer, but we can't. That is what we call a fair housing violation. So if I know that you have a kid and I'm picking you because you have a family, then that is a violation of fair housing. There's 7 protected classes that we cannot choose from for people to pick a house. But I wish. The folks that are the types of buyers that can win in this market are the folks with the strongest credit, the folks that have the most cash. So if you have cash flow available that you can use as money as a leverage or negotiating tool, and you can actually get to the closing table because your credit is strong, you don't have any debt that's going to get in the way, you're not going to have any surprises that are going to pop up on you as far as liens or past due taxes or past due student loans, but you've really taken care of your credit. And that's why I created the S.P.A.R.K program, because I wanted to be sure that my folks would be prepared to fight in this market, because it is a fight, I promise you. All right, so my other question that I get a lot are people are overpaying for homes, aren't they? Everybody's coming out here paying $20,000, $30,000 over asking. They are. But what we're seeing is that those home values are accurate. These homes are appraising for that amount. These homes are maintaining their value. So people that bought homes in 2020 and in 2021, we're seeing a steady hold for those home values. So, and they're increasing. And economists are projecting that over the next 5 to 7 years, there will continue to be a rise and increase in home values. So people are overpaying for homes. And especially with interest rates as low as they are, they're not overpaying for homes. As long as those home values continue to hold steady, then you're going to be okay. It just seems like you're paying a lot because it's over what the asking price was. But the idea of what it means long-term for you and your family is what you want to think about, as well as the interest rate that you have. Before I move forward, what questions do you guys have for me?
You may touch on this later on in the session, but when you think about credit, what is an ideal credit score when looking into applying for a loan? Because I'm so scared to apply because I'm like, oh, you're gonna touch my credit. Nope, you're gonna dim my credit. Oh, it's gonna be for everything. So I'm so scared to apply. So what is an ideal score for the housing market?
In this market, a 640 or higher. Okay. And the reason that I'm saying 640 or higher is because you're going to have a very strong financial profile or a strong financial file. So when that lender pulls your credit and they start to look at your file, and every lender is different. They all have different algorithms and different FICO scoring models that they utilize to determine if you're going to qualify for a loan. But if your credit score is a 640 with their scoring models, their algorithms, not Credit Karma, because Credit Karma can be about 20 to 25 points off on any given day. I promise you.
You'll see Credit Karma. They're like my go-to of tracking right now.
It's okay, because that's still a good habit to have, is to continue to watch your credit. But do not be surprised if you go to a lender and they run your credit and your score is off. Okay. I've had people come to me angry. My score didn't drop. Credit Karma shows my score is a 680. And the lender pulls their credit, and it's just different because every lender has a different set of scoring models that they use. And so there are some lenders that you'll go to and you'll have a higher score. Some it will be lower. But overall, what the lender is using is what matters. Credit Karma is good to use to track, to make sure that you're staying on task, but do not lean on it heavily to show that it's an accurate credit score. Just know that it can be off. The lowest I've seen it be off is like 10 points off, but the highest has been 20. A young lady that closed in 2020, her score, when she applied, she was gung-ho that Credit Karma was spot on, and the lender told her it was a 20-point difference. So just be mindful of that. Every lender has their own scoring models, and that's the one that matters, not the one that's on your app. So a 6.
Question.
Oh, sure. Well, did I answer your question about the credit score?
Yes.
Okay, good. Yes, ma'am. Amina's mom.
I don't know how deep this question or the answer might be for this, but regarding related to the credit score and what they're looking at, and for example, student loans, with all of the changes that are happening with student loans, are they looking at those a little differently now, given the lawsuits that are appear to be valid and going to go through, as well as like the freeze on the student loans and the possible forgiveness process?
So the lender is going to look at what your financial profile is in the moment. So they've deferred student loans for everybody. I think they just renewed it again till June, if I'm not mistaken. That is fine. It's when you have defaulted. So if you were in default before they deferred people's loans for the pandemic, then that's where you're going to have trouble. If you haven't defaulted, but you're not current, like maybe you were like one payment behind or something like that. If anything like that shows, there's nothing that anyone can do except for get that corrected with the student loan department. So your lender will tell you to go back to your student loan company and find out if you can use an income repayment plan to lower your payment and then get back on track. And then it would be like a 60 to 90 day period to get back on track. And the reason I say this is because I had a buyer last year in April, his student loans, well, I'm sorry, it was in September. He thought that because his student loans were in deferment like everyone else, he was going to be fine. It wasn't going to show up, but it showed up that he was defaulted. And they made him bring his student loans current. So every lender is different. But in my experience, if you are defaulted, you want to make sure that you get that addressed with the student loan department prior to applying for a loan. But if you're still current and if they're just deferred, then you're fine. You should just see a 0 there when you go and log in. You see a 0, you should be fine. You shouldn't have any issues. As far as the government clearing the debt, your lender isn't even going to consider that until it actually happens. So they're looking to see how much of your income is going to those student loans when it comes back on track and it's time to pay. So that impacts what's called your debt to income ratio. If your debt to income ratio is high, meaning you have more debt than income, or you have too much debt relative to your income, that's a red flag for them, because now they're going to try to factor in what your potential mortgage payment would be, along with insurance, taxes, and interest. And so once they see that number coupled with your student loan payment, your anticipated student loan payment, they may say, no, you can't really afford this house. And so they'll deny your loan. But you will not know until you apply. So going back to the first young lady that said she was scared to apply, you got to apply to find out. And so, yes, there will be a hit to your credit when you apply. But it's the only way that you will find out. And it's not, going to take your score down 100 points or even 50 points. It's an inquiry on your credit. And it has to be done in order for you to find out what that lender is going to require for you, including what your student loan situation is, because they'll be able to pull your credit and they'll be able to see everything that's on there. Yeah, everybody, that answer your question?
Yes, thank
you. Okay.
I have a question for a friend.
Sure.
If she doesn't have a score of 640 or higher, is there a program that will work with her to improve her credit score?
So first, let me say, there are some lenders that will qualify you at a 580. So I'm not saying you can't get a loan at a 580, but your interest rate is going to be high and you don't have the financial profile that you should have to be a homeowner. So my goal is not to just put people in houses, just to put them in houses. I'm putting you in a house because I want you to be able to stay in the house. So if you have a 580 score, that means a couple things to me. That you ran into some situations in life and it's been tough and you had a hard time coming out of it and you're trying to come out of it. But you have to establish good financial habits in order to get out of that situation. As a realtor, for me, I want to make sure that you establish those good financial habits before you get into a house, because a house is different than renting. And so if you rent and the water heater goes out, or the washer breaks, or the disposal goes out, you can call your landlord to fix it and it's no charge to you. But as a homeowner, you need to have that cash flow available to make those changes. So you can get approved at a 580. I will tell you that there are certain lenders that will go ahead and push you through. I think in this market, it's very risky to do that. And I would not recommend it. But if you are not going to try to push the envelope and you are patient and you're okay with waiting to build your score up, then your lender will work with you and create a framework with you on what you need to do to build your financial profile. So I have 4 preferred lenders that I use. And what they do for my folks that are credit challenged is they tell them, this is what I want you to do. And they're not going to charge them for anything. Okay. They don't charge them for this. They're giving them the advice. Based on what I see on your credit score, you're going to need to pay down this, pay off this, and then save this, and that. They're going to give them very specific instructions for what they need to do in order to qualify for the loan. Then they'll have them come back within 60 to 90 days, usually 90 days, and they'll run their credit again, and they can find out if they've made the necessary changes that they need to make to improve their score. You don't necessarily have to hire a credit repair specialist. Nothing against credit repair folks. It's just that when they start going in to dispute things on your credit, that actually can hurt your score. It'll hurt your score before it helps your score. And it's not until all of those disputes are removed that you can actually apply for a loan. And sometimes that can take up to a year. So it just depends on if you can be patient and just do the work. You will save money by not paying a credit repair specialist, and you may be able to get into a house and get done with this process a lot sooner than if you were to go with like a credit repair. So that's why I said just talk to your lender, and the lender can guide you through what they require. Because a lot of times people think they got to go pay off their student loans, or I have to go pay off all my credit cards. And the reality is the lender may only say, oh, well, if you just pay off 2 of the 10 credit cards, you'll be fine, and we can get you approved. And they're like, oh, it's not as bad as I thought it was. Their score is usually higher than they think it is going to be. And then they're surprised at that. And then the lender will just say, all right, just to make sure you're ready, this is how much you'll need for a down payment. This is how much you'll need for closing costs. Let's get ready to save that money. And they'll shoot me an email and they'll tell me, this is the plan we've got for her. Let's go ahead and implement. Let's follow that plan. So it just depends. Now, I will say a Wells Fargo, a Bank of America, I got to be honest, they're not going to do that for you. But if you have a smaller bank, like a credit union, or maybe a local bank, like Bank of Oak Ridge or something like that, where you have a relationship, they'll help you. Or you can use one of my preferred lenders, and I can make sure I provide that for you guys as well. Did that answer your question, Ms. Erica?
Yes.
Okay. All right. So let's jump into the benefits of being homeownership. I'm sorry. Renting versus buying. What is rent doing right now, guys?
Going up.
Going up. Okay. It seems like every month I'm hearing a story about somebody's rent going up. I heard of a 1-bedroom for $2,000. And I said, well, I think it might be time for you to buy a house. And so the issue sometimes is folks are like, well, this market is so expensive right now. I don't know if I can qualify. I'm probably just better off renting. I will tell you that your rent will continue to rise as long as the market will allow it. So as long as there is a decrease in a decrease in the number of homes available, there will be an increase in rent because there's going to be an increase in demand. So they're building, as you drive around the Triad, you will see there are apartments being built left and right. Investors are buying up homes left and right. These folks that have millions of dollars in hedge funds and these huge, massive companies know something that a lot of consumers don't. Rent is going to be the thing that's going to pay their bills and passive income for years to come, because people will stay locked into the mindset that renting is going to be better for them because it's going to be cheaper, but it's not. When you have a mortgage and you get that mortgage locked in, that's your mortgage. The only way it will change is if your interest rate changes. Maybe you refinance and you get a different interest rate, hopefully lower. If you have an adjustable rate mortgage in which your mortgage is subject to increase or decrease over a 5-year period, a series of 5 years, or maybe your insurance or your property taxes increase. But none of those are as significant as your rent increases are going to be. When I was renting an apartment fresh out of college, I won't say how long ago, my rent was $480 for a 1-bedroom, 1 bath with a screen porch. Love my screen porch. $480. And for somebody to tell me that a 1-bedroom now is $2,000, I'm floored. I'm floored. So you can have a whole house that's yours, that when you make a payment, it's contributing towards that loan being paid off, and it actually having your name and money that you can pass down to generations if you choose to do so. And so renting versus buying for me is a no-brainer. Now, there are folks that I do feel it makes sense for them to rent if you're a traveling nurse, or if you're someone who's really never home, and you just feel like, you know what, I don't really want to put roots down. You don't have to put roots down. Okay, you can pay the rent. That's okay. But for those of us that are trying to build legacy, that are trying to build beyond where you're at right now, and you want to have something to pass down, buying is going to be it for you. All right. In addition to that, you will have what we call equity. Equity is money that you can pull out of a house, and you can pay down debt. You could do renovations. If, let's say, you need somebody to, you need to give a loan to somebody, you can do that. I don't recommend that. But equity gives you financial options that you may not have had. If you own more than one property, let's say you have an investment property, you can liquidate that, meaning sell it and just get the cash, because you have somewhere to live. So now you've got cash to play with. You need to pay for a semester of college, want to buy your baby a car. You have options for things that you can do if you have a home. Even if you have land, you have equity. You have money that you can pull out in some cases. And then you can sell that land to a developer who wants to build something on it. And you're going to make more than what you bought it for in most cases, unless it was just like 100 acres and you've got to find somebody that can beat what you bought. But most of the time you will have some equity in what you purchased over time. And then you also have leverage. And leverage gives you the freedom to do the things you need to do. So if you buy a house now and you need to move later, you can use the cash from the money that you make on your home when you sell it to purchase your next home and save some of the money that's already in your bank account or in your savings. There's just so many benefits to having something in this earth that you can call yours. And so, yes, you'll be partnering with the bank until you pay it off with your deed of trust. But you have leverage because you can sell that land to pay off that loan and get the difference. Okay. And once you pay it off, it's a really beautiful thing. And so there's so many different layers to that, as far as like creating trust and, creating the correct paperwork for if you were to go on to glory, and you wanted to make sure the house was passed down to to your children, or if you have multiple children, how to set that up. That's a whole nother ballgame with estate planning. But there are also ways that you can improve the financial position of your children using real estate, okay? Because it is one thing, Jesus isn't making any more land, okay? Whether you believe in Jesus, crystals, crosses, the universe, no more land is coming, okay? The land is it. So if you own some of it and you can pass it down, then you're building a legacy for your family, and you're giving a launch pad for the next generation that someone may not have been able to do for you. So those are the benefits that I have a little bit of time to share with you today, but there's so many more that we can think of, and some of the resources I'm going to provide to you guys afterwards will also dig into those. Right? So I'm going to pause for a moment to see how you feel about those homeowner benefits, home ownership benefits.
Okay, it's me again. Renting versus buying. I have said I'm a faithful renter because of the responsibility. But secondly, I feel I'm at an age, and I'm not old. I'm heading at 37 with kiddos. And I'm at that age now that I'm like, it's too late to buy. I want to buy, but I feel like it's too late to buy a home.
Mm-hmm. And why?
Thing.
No, Not at all. I've had a first time home buyer that was 50 years old. It is never too late. It's never too late for anything in life. Okay. I am engaged and getting married for the first time at 40 years old. For some people, they say that's too old. I'm an old bride. I'll be an old bride shuffling down that aisle in my dress. Yes, there's no such thing as too old to be a homeowner, because you will always be able to build equity. You will always be able to get that leverage out if you need it. And especially in this market where things are going at a very rapid pace as far as equity being built. So I had someone, he was 40, I think, I don't want to say his name, he was 42. He bought a house in May of last year. He's coming up on his 1 year anniversary. I just sent him his the home value just to kind of keep him abreast of where he was standing. He's already got $25,000 in equity on that home, just because of what was being sold around him so quickly. So even at, mid 35 and up, you're actually at the perfect age to buy, because now you understand the importance of what it is that you're doing, and you don't mind seeking out the wisdom to manage it. When we were young, because I bought my house at 26 years old when I bought my house, I didn't have the wisdom to have that townhouse. I didn't know what I was doing. And so I didn't have the mindset to save money for repairs. I didn't have the mindset to have a maintenance plan for my house. I wasn't mature enough for it. Now I'm grateful that I did, because I have equity now that I can pull out of when me and my fiance get married. But I didn't have the wisdom that I needed to be a homeowner. And so there are definitely folks that are younger and they have the wisdom, because there's so many resources out there today. But I feel like at this time in your life, you're mature, you're ready, you're comfortable with yourself. There's so many different benefits to doing stuff at a more mature age than it is doing it at the younger. Because we're not in the 1950s anymore, where we got married fresh out of high school, had 2 babies, a golden retriever, and a house with a picket fence. We are beyond that. And so now that we're learning so much more about who we are and what value we have, it makes sense to wait for some of these things now, because it allows you to gain more wisdom on how to manage it. So no, don't ever think that you're too old to do anything, much less buy a house.
Got it.
All right. Anyone else?
It's just me again.
Sure.
With my other fear, because I did come across where I had to purchase another vehicle that I am currently financing through my credit union. That has been my other setback, because I'm interested in buying, still a little leery because I just got my vehicle. And again, I'm so like, I can't do nothing on my credit right now because I just got this car and they're going to see this new loan on here. Should that be a deterrent to even possibly going through my current credit union of making that type of inquiry, or should I wait an additional 6 months or a year?
How long ago did you buy the car?
September of 21. So it's been about 6 months now.
Go on down there and see what they talking about. So listen, it's going to impact your monthly debt to income ratio, which is what they're going to look for. How much a month are you paying out? So yes, it is going to decrease the amount that they would approve you for your mortgage. Okay, it is, because they're going to look at that car payment and say, all right, we've got to deduct this off the list for the amount that's got to come out of your monthly expenses. But that doesn't mean that you won't get approved, because your income may be sufficient to take care of that debt and handle a mortgage, but you won't know until you go. So I've heard fear. I'm scared. I've heard that just pretty much this whole call. You can't be scared. None of you can be scared, because you won't know until you go.
Okay.
Listen, it's something called, here at Keller Williams, we talk a lot about mindset shifts. And so I will veer off of that for just a moment, off of this topic, just to get into mindset. A lot of things that I also have my buyers do when we start this process, especially if I know it's going to be a journey, is I have them set their affirmations. Set you some affirmations. Every morning, say them. I am a homeowner. I am debt-free. I have the wisdom to manage my finances. Say those 3 things and you will start to see those things manifest, okay? And you can't have what we call a limiting mindset. A limiting mindset or a limiting belief system means that you are putting limits on yourself that may or may not exist, but you're not giving them a chance because you've already said, I'm scared, I'm not going to, I can't, I won't, I'm afraid. And then you'll look up and it'll be 10 years that have gone by and you were like, oh, I should have. Okay. So the very first thing that you have to do with this S.P.A.R.K program, and the PDF that I sent has a section for you to print something off. You can print the page off, and I want you to write in what you want, because I believe in writing it down, write the vision, make it plain. Come on, somebody. But you can write it in, and that way you can see it. Every morning when you wake up, hang it up on your mirror. I'm going to go ahead and just pull it up so y'all can see it. Too, if Miss Erica sent it over to you guys, where's my PDF? I need. Oh, go ahead.
With my kiddos, like literally over this past weekend, because they're in some in high school, some in middle, and some in elementary. So I said, we're doing vision boards. I didn't think of doing one for myself because I'm just trying to get them through, have them a goal, college, what it takes to get into college and such.
Mm-hmm.
Think about myself.
Yeah, you got to think of yourself first, because you're going to lead. You're going to lead the charge. And so they've got to see that mommy's doing it too, and that mommy has a plan. Oh, I keep forgetting. I logged out of my PDF and I can't get back in. All right, let me pull it up here. Yes, do your own vision boards, do your own affirmations. And then just, even if you don't have the board, you just want to do some sticky notes, go ahead and take some from the job. You know you did it before. Take some sticky notes from the job. Okay, they're not gonna miss them. If you still going to the office, I promise, some staples too, go ahead and get you some. And do your put your affirmations, your six little things that you want to say to yourself. And you can just continue to speak that over your own life and into your own future, and it will manifest. The 2 folks that complete, because I started off with 10, y'all. I started with 10 folks at the end of 2020, and only 2 people stuck to that program. 2. And they both closed. One closed on their house in December of last year, and the other one closed in October of last year. They both stuck to it. And so it can be done. All right, so let me see if it'll let me present it from here so you guys can see the section I'm talking about. Sorry, I think that's just the cover. It is. All right. It is like page 2 of the action plan, I want to say it is. 3. This is the one. Page 3. And so let me zoom in for those of y'all that are visually challenged. Put your home buying goal, and then identify if you are interested or if you're committed to it. Because there are people that come to me, and I can have 3-4 appointments a week, people that want to buy. Oh, I'm interested in buying a home. And out of those 4 people, I might have one that's really committed to the process, who's really going to do the work to become a homeowner. So you have to really be honest with yourself if you're interested or committed, because I'm going to put in the work for you. I'm tenacious. I'm going to go after it. But if you're not going to go after it, I can't want it more than you will. So identify, really have a true conversation with yourself if you're interested or committed. As far as your goal, it should be, I will be a homeowner by this year or this date. Some people say by their 40th birthday, by their, 16th wedding anniversary. Whatever your goal is, put that here. Write it down. I want y'all to print this page and write it down. What's your motivation? What's your big why? Or your little why, for that matter. If you got a bunch of little whys, then write those down. But what is your motivation? Why do you want to do this? When do you plan on starting it? When is the deadline that you absolutely are going to hold yourself accountable to actually completing it? And what's the reward that you're going to give yourself for buying your house? Okay. Don't reward yourself till after you close, though. We don't mess up your closing. All right. And then what are the obstacles that you have to face to overcome? Is it the number of hours that you're making? How much money you're making? Do you need to increase your income? Do you need to decrease your debt? Are you a single parent? Are you married, but they're just not on board financially? Whatever that is, I want you to have a very honest conversation with yourself about this. And then what are your resources to help you overcome these obstacles? Okay, that would be things like your lender. That would be those affirmations that you need to do. There are actual playlists on Apple Music that are affirmations for different things. Whatever you want to do, they have those already played out. You can have them playing while you sleep. Some people are scared about that because that's playing with your subconscious, but it's up to you. You can play them in the morning when you wake up while you're getting dressed. But what are those resources that are you going to use? And then I have it outlined here for you. Here are your big steps. You're going to create a budget, contact a lender, pay down your debt, and save cash. Those are the big rocks, okay? But within that, you're cutting your spending. That's going to be the hard part, cutting your spending. My fiance and I have committed to 1 whole year starting January 1st of next year where we are not going out. We're not eating out. We're going to just do it old school. We're going to have wine in the back patio. That's as close as we're going to get. And somebody's going to have to gift us the wine because we're not buying that either. The goal is to make sure that all spending is cut so that we can pay down any debt that we have and so that we can set the down payment for our new house. That's the goal. So cutting spending is going to be a big part, but also track your expenses. Track those expenses and your income. You have to keep all of your bills current and control your limiting beliefs. So control that says, because we talk the worst to ourselves. You don't talk to anybody else like you talk to yourself in the mirror. I guarantee you don't. And so you have to shift your limiting belief system and watch your mouth. Because every time you say to yourself, oh gosh, I feel like this home ownership thing ain't ever gonna happen for me. You just put it in the atmosphere. And depending on what you believe, like I said, crystals, crosses, all right? It don't matter. That universal principle is there, okay? So you speak over your life what you want over your life. And so if you limit your belief system, then you're going to have a limited lifestyle. So control that, okay? So these are your little steps, but that really probably should be over here with the big steps. And any notes that you want to take to remind you, put this up on your mirror or somewhere you're going to see it and stick to it. Look at it every day and be determined and fight for your dream. Fight for your dream. Okay, so this little thing I printed out, I had to make some adjustments, but this is also in that guide where you can actually track what your money is, what your income streams are, what your savings is. If you have any investment accounts like 401ks, yes, your 401k counts as an investment account. And yes, you can pull money from your 401k for a home purchase, but we'll talk about that. Your credit score by the end of your goal month. So I want you to track it for all 12 months. What is your credit score by the time you want to hit your goal? The goal again is a 640 or better because it shows that you have good financial habits. Okay. And then put that number down. Get your credit report from freecreditreport.com. You get one free one every year. Print it out. Get real with yourself. What debt do you really have? You don't have to talk to a lender to find that out. Print your credit report out. Get a highlighter, get an ink pen, and determine how you're going to tackle what's on there. You will not know until you print that credit report out. Your credit score can tell you things, but it doesn't give you all the details that your credit report does. So what you see on an app, what you see as your FICO score from the credit union, freecreditreport.com, download it, get a highlighter, get an ink pen, and get to work, okay? You can start saving. You're saving things like your closing costs, your down payment, the expenses that you have associated with the transaction, such as an appraisal, an inspection. That's cash that you need to have on hand. If it's possible, if you have a W-2 job, you're not an independent contractor or business owner, some companies will allow you to set up automatic drafts to your account. So it's direct deposit. Some jobs have an option where you can direct deposit to an additional account. So they'll split the money for you and it will auto deposit into that account. If you're a member of the State Employees Credit Union, they have something called a Christmas account, a Christmas savings account. I use that every year to be sure that I don't go into debt at Christmas time. You can see if they have another program that you can use where they auto draft and deposit into an account. If you can use the Christmas account, use that Christmas account for saving for your house, okay? And you determine how much you want them to pull every month, and they are going to pull it. Be prepared because it's coming, and you cannot access that money until October 31st of each year. So they won't give it to you. You can't withdraw it. Well, technically you can request it, but don't, okay? Also in that guide, I provided you the lender partners. Remember I said I had my favorites? These are my favorites. These are the folks that will create that framework and work with you and help you. If you're not a member of the credit union, state employees, you can't use Leatrice, but everybody else on here can definitely help you and will take good care of you, okay? So I shifted away from my plan because I felt like y'all needed to hear that. Got to get out of that limited belief system, create your own vision board or your own plan for what you want and stick to it, do your affirmations and change your belief system. Because that's going to mean the world to you during this program. So I know that we are near the end of time. So I do want to provide some resources for you guys. The Earn Your Leisure podcast is awesome. It is 3 gentlemen that are awesome at breaking down everything finance. And sometimes even I can get discouraged and I'm like, man, I don't want to hear this. I can't do nothing with cryptocurrency right now. But the reality is we need to kind of continue to feed our minds and feed your minds with something finance related on a consistent basis. Become comfortable with finances. A lot of times in our cultures, we didn't really necessarily talk about finances with our parents and our grandparents. We had to stay out of their business. But we need to shift the mindset about finance, shift the mindset about saving, what it is to invest and not just sit money in a cookie jar. Because sitting money in a cookie jar is money that's not working for you. And you want to have your money start to do things and work for you, even at a small scale. Okay. So Earn Your Leisure will allow you to kind of open your mindset about how we think about money. And then Dave Ramsey, Total Money Makeover, will help you create a budget and a plan to get out of debt and to pay down debt on a scalable level. You start with the smallest and you work your way up. People that are really financially in tune will say that's not the way to go. You pay down the stuff that has the highest interest rate first. It's whichever one works for you. Your goal is to pay down debt as needed based on the lender. You can also follow me on Facebook or Instagram. And I also have a home ownership video series on YouTube. I need to update. I need to do another one because that was at the end of 2020. But a lot of the principles are still the same. Okay. And that's a series of 9 different videos. And I've partnered with lenders. I've partnered with new construction sales agents. I have a financial advisor. I have pretty much everybody that you need to buy a house on board. I would say the only thing I'm missing is an inspector, but they just kind of give you the foundations that you need to become a homeowner. So that's it for me. I thank you guys for taking the time to be on this call. I hope that this was helpful and beneficial. And I'll toss it back to Miss Erica.
Well, I have a couple of questions. I'm responding to our live.
Sure.
And you may have hit this. One is, can you explain the necessary needs for a down payment as far as percentages go?
So as far as percentages go, it varies by your loan type. So a conventional loan could be anywhere from 5% to 20%. Don't think it's automatically 20% because it's not. Then you have FHA, that's a 3.5%. USDA is 100% financing, so there is no down payment. And then you have your VA loans for my veterans, that's 100% as well. And then state employees has some programs as well that are 100% financing loans as well that are conventional. So it just depends on the type of loan that you want. But just remember, any percentage that I provide that's that percentage of the sales price. So if you want a $190,000 house, it's 3.5% of the $190,000.
And I have another question. Let me find it. It came through. Did you go over the different loans? You may have hit that already.
So there are tons of loans. There are a lot of loans. So yeah, I did just describe like the FHA, the VA, USDA, conventional loans. There are ARMs, adjustable rate mortgages. There are different loan programs like, I think they changed the name. I think it's HomePath now. It used to be My Community Home Mortgage. So there are different programs that are available, but it just varies. So what the lender will do is take your credit file, they'll run your credit, look at your credit file, and they'll see which loan type fits you best. And so if you're not cash heavy, you don't have a lot of cash, then an FHA would be an ideal option for you because it's only a 3.5% down payment. But if you are a veteran or you don't mind living in a rural area, you may be able to do a USDA loan or a VA loan. So that varies based on your credit report, your credit file, what your goals are, what you want to do, where you want to live. Because there are some limitations with FHA, like sometimes condos and townhouses with their HOA fees and things of that nature are a little bit more difficult to qualify on an FHA. With the condition of the houses, if it's a house that's got chipping paint or structural issues, you're going to have some challenges with an FHA loan. So there's just so many different variables. So we would have to really sit down and look at your individual situation to determine which loan would fit best.
And the last thing, I know you left your, I'm sending this to the person that I'm asking questions for. I know you have your information here. Is this the best way to get in contact with you for her?
You can also call me or shoot me a text. 33. Let me put it up here.
I was gonna say, can you share your number?
Yeah. I can put it in the chat.
Okay. She'll look back at this. And I don't know if anyone else has any more questions or any questions.
I'm always full of questions, Miss Erica, but I'll probably just give her a call. It's my
Well, ask, because it may be someone else on here that has the same question. And I'm asking a couple of people ask questions that my friends asked me to ask. So you never know. Okay, and her email is in the chat, and the phone number for those that don't know how to get to the chat is 336-456-1974. I am rooting for all my friends to become homeowners.
Yes, it can happen. It can happen. I will say this market is definitely challenging for first-time home buyers. And what I do encourage you to do is to, if you already have an agent, have a heart-to-heart with them about the realities of shopping in this market. It is not for the faint of heart, and you have to be really committed. And if you are not cash heavy, it is going to be extremely challenging. You could submit somewhere between 5 to 10 to 15 offers and lose every single one of them. Because there are people that are coming into the market with $20,000 to $30,000 in cash. It's not always just investors. There are people with that kind of cash that are coming out and saying, hey, I'm going to put this money up. And they're using what we call due diligence money. And due diligence money is money that is given to the seller to take their house off the market. And you get the opportunity, you get a time frame to investigate the property. And you could get your appraisal done, you could get your inspections done, and you have the right to walk away from that property without being in breach of contract. However, you lose your due diligence money if you walk away. So for the seller, if you're willing to give me $10,000, I feel like you're pretty much going to go through with this deal and you're not going to walk away from it. But someone giving me $2,500, there are people that will leave $2,500 on the table because they got cold feet. And I've seen that happen. So the more cash you have in this market, the better chance you have of winning a multiple offer situation, which is almost going to be pretty much every situation. There are a few where the house has sat on the market for 10 days, 14 days, 20 days. It's very rare, but in those situations, folks that aren't as cash heavy have an opportunity to win. But those houses do usually have their own set of challenges. So I would just encourage you that if you don't have a lot of cash to play with in this market, that you take a step back and save a little bit longer if you can. But if you absolutely have to move right away, maybe 6 months from now, you really have to get out, then your agent will do whatever they've got to do for you. And you'll figure it out. We'll figure it out. But if you can wait and stack and save and stack and save, then I would highly recommend that you do so.
Miss Erica, do I have time? It's me again. Do I have time for 2 more questions now that soon as she said that, it sparked one of my questions?
Yeah, if she has time, I have plenty of time. I'm up all night, but it's up to Annette. You have time for a couple more questions?
Sure.
And also, I'll share the link where this will be the recording when we post it.
Okay.
While she asks her questions.
Okay.
So when you say a little bit of money or some money set aside, what is an ideal amount of money to have saved even before, I shouldn't say even before going and inquiring or see where you stand as far as with the lender, but what is an ideal amount of money you should have saved?
So you want to have enough money for your down payment. You want to have enough money to be able to cover your closing costs, your due diligence money, as well as your transactional costs, like your appraisals and inspections. So depending on your price point, I usually tell my folks, somewhere between 8,000 to 10,000 on if you're looking in the lower end. So if you are looking in the 190 to 200, 250,000, well, no, because that particular range now is super competitive. I would say if you're looking in the 125 to 160 range, maybe somewhere between 8 to 10, and that would cover everything. So that would be your down payment, your closing costs, your inspections, your due diligence, your appraisal costs. All of that's rolled into that. But as we go up the pipeline, I'm going to tell you to save, to have a little bit more. So you can have somewhere between 15 to 20,000. That would be fantastic. But if you can't save that much, so if you're looking in the $250,000 price range, that is the most expensive price range as far as demand. A lot of people are looking in that price point. So in order to stand out, the more cash you have available to submit with your offer, the better. And every offer, guys, you're also going to have to submit over asking price in this market. So anywhere between 5 to 10,000 over asking is competitive. But in addition to that, you got to be prepared to cover the difference between the asking price and what you offered in the event that it doesn't appraise. It's a whole nother layer to this. So it depends on the price point you want to be in. Okay, depends on the price point you want to be in. And so that, for me to give you a more specific number, we could take that offline and talk about what your specific goals are. Or if you have an agent, you could talk with your agent about what your specific goals are and how much you want to have set aside, because it is going to be based on your price point and what kind of home you want to move into.
Great. I do not have an agent. I'm glad I took this session tonight. You will hear from me.
Yay, that's awesome.
Oh, my second question is, and the last for tonight until I speak with you, is I have, like I said, I've been a faithful renter. The inquiry and thought of home buying has been there probably the last year now. I am coming up on that time to renew. And I know with renewing my lease, I already know it's going to be an additional 125. I already know it. It's been like that for the last 3 years. It's going to be like that this year. It might be 150. Who knows? However, I do have that option to do rent month to month. That's where I come into that leery part of, do I inquire to go to a lender and see where I am and just do the month to month in hopes that maybe by end of year I'll be able to close? Or where I am now, what is the just recommendation on that when you're getting close to, it's that renewal point and buying a home? Like, because if I'm gonna do the buying a home, I'm going to like go ahead and just take that route, because I do. I'm a little scared, but I do want to.
Yeah, no. So month to month is beneficial for, if, because they usually will charge you more to do month to month. But so if you can afford the additional increase to do month to month, I would stick to month, because it is going to take you some time to find a house and get in a house, just because inventory is so low. So your month to month would be great, because then if we run into, like, let's say you're in a price point where you could qualify for new construction. Sometimes they have houses who have contracts that fell through, or they have showcase homes, and it'll be ready in 4 weeks. Like, oh my gosh, yay, we just moved because you did a month to month. But if you renewed a 6-month lease, that might not be an option for you unless you want to pay to get out of the lease. So it's really what you feel comfortable with doing. And I would check with my leasing office to be sure of what they expect of you if you're going to break your lease. Because some people will be like, yeah, we just want a month. We won't have a problem renting it out. Just pay us an extra month's rent, you're out. Have a good life. But then there's some that are like, nah, you got to pay the whole rest of the lease up. I'm like, what? So it just depends on your landlord and what their expectations are. So if you have your lease that they gave you when you signed it, you could go check, or you could just go to the office and find out what their requirements are. And it just varies, because depending on what that cost is will really make a difference. So you could go month to month if that works for your financial plan. And then I had a client that she renewed her lease while we were looking, and the timing was just perfect. Her lease was up, I would say a week after she closed on her house. And it worked out for her to have that 6-month lease, because we started searching in April, and every offer we submitted just did not get accepted, until we decided to get a little risky as far as cash flow. And she put up a little more cash and we got it. But that took from April to August, the end of August, before we were able to get one secured. So it just varies because inventory is really low.
Okay, thank you.
You're welcome. Any other questions? I gave my 7 Mississippis in the training world. That's the appropriate pause for questioning. So if there are no more questions,
I think we have one more question.
Okay.
Hold on, they're zooming in here. And while she's getting her mic to ask a question, I put in the chat where you all can listen to the recording if you need to go back and listen to it. And her information is here if y'all want to screenshot it or whatever you do.
Put it back in presentation mode.
Should you worry so much about, I'm sorry, it's me again.
You're fine.
With student loans, because I'm literally, and it's not a lot, and I'm almost done. I have $750 left on my student loans. with that still being there, would that hinder my, what is my question? How do I want to word this? Will that hinder, if I have a cash flow, but I still have that on my credit, and again, Credit Karma has been my friend right now because it's been my basis, but with the student loan still being there, I am on the children. With that still being a balance showing there, and I think it actually shows 0, but I've been paying on it still, even though it's been deferred or on hold or what have you, paying on that, and I have the cash flow, will it potentially defer me from getting, or defer a lender from seeing me?
It just
I guess.
depends on what the monthly payment is and your current debt to income ratio. So if you have a high monthly payment on that, it could potentially hold you back. But if it's not a high payment, then you should be fine. But that's still something you wouldn't know until a lender pulled your credit and told you. I'm pretty confident it's 750 left. You should be all right. But as long as they're not defaulted, you should be fine. But if it's a big payment every month, then they will have some concerns and they may just tell you to try to pay it off.
No, it's they called me last month because they changed providers or the company, and it's 0, but I can opt to go ahead and make payments on it, and that's what I've been doing. Even though there's not a payment due right now, is what they're saying. Like, I don't have a payment. It keeps getting pushed, like every 6 months. They'll call and say, due to whatever, your payments are still showing as a 0. You do not have to make a payment until January. And then they called me last month and said, due to whatever, you don't have to make a payment until your payments are still $0 a month until I think August is when my actual payment is supposed to start up again. But I've been making payments towards it, like on my own.
And that won't hurt anything. That will only help you, because basically you're making those payments and it's knocking down that balance. I've been doing the same thing. See, it says 0. No, y'all still gonna get this dollar. Here you go. So yeah, if you're still making payments, there's nothing wrong with that. That's not gonna hurt you. You could tell the lender that you're making payments, but you should be fine, especially with that balance being that low. You just have to talk to them to find out exactly what they think.
I told you I'm scared to go talk to the people. I can't even let Firestone run me. They was like, if you apply for a credit, we'll give you your oil change free. I was like, no, that's okay. I can't do it. I'm trying to redo my credit right now. That's like my fear, because I've gotten it ran one time, and you're right, it doesn't take much off, but the little that it takes off, it seems like it takes forever to get those points back. And that's what I'm like, I can't afford to have anybody even do an inquiry. Don't even ask me what my last name is, type of deal, because I'm so afraid that it's gonna those little points, it takes so long to get them back up.
Yeah, but the mortgage one, I will say, is when there's absolutely no way you'll know until they do. And it will jump back up. It'll come back. Just even like things like if you pay, so like I paid my car off. Okay, I paid my car off and my credit score dropped like 20 points. I was livid. I was like, what is this all about? And it's because it's an account that closed. So the account closing showed that there wasn't a credit line available any longer, and it dinged my credit. Now it took 60 days for it to jump back up, but boy, did it shoot back up. And so just know that those little dings are there. Just don't make a whole lot of dings. So don't go apply for a car, credit card, and a house all at the same time. Just do your house. It'll be a little ding, but in the time that you're looking for a house, it's going to adjust. It'll be fine. Just don't do any other dings.
My car, it was the last ding in September. So That's why.
And that's enough time. So if it was like, if you were trying to go and apply for something in November or December, that may have had more of an impact on your score. But It's about to be April, so I think it should be fine.
Okay. All right. So thank you so much. And I don't think anybody else has any more questions.
Okay, and y'all can feel free to give me a call. Work 8 to 8, Monday through Saturday. So anytime between those hours, any info after 8 p.m., I will respond to you as soon as I can in the order received on the next business day.
Sounds good.
Well, thank you again, Miss Erica. I hope y'all have a good night.
You too. Thank you. Everybody
Bye.
have a good evening. All right.
Thank
Bye-bye.
you.